Let's reset the frame for a moment. It's January 9th, 2026, and something decisive has already happened in the silver market. Not something subtle, not something you'll understand 6 months from now with the benefit of hindsight, something structural, visible, and, if you know how to read it, impossible to ignore. The silver rocket didn't warm up on the launch pad. It's already in the air. And the uncomfortable truth is this: the odds of seeing old price levels again are shrinking fast. Not because of hype, not because of social media excitement, but because the market itself has spoken. My name is William Lee, and I want to walk you through exactly why silver surged what shifted in the last 48 hours, and why the decision in front of you right now is far more binary than most people realize. You're either positioning ahead of what comes next, or you're standing on the platform explaining to yourself why you almost got on. Let's start with what most people completely misunderstood yesterday. During the London session, silver dropped to around $74 an ounce. If your information diet consists of sound bites and headline panic, you probably heard the usual chorus: the rally is done, silver is rolling over, smart money is exiting. Same song, different cycle. But that narrative collapses the moment you actually look at the chart instead of listening to commentators who have been wrong at every major turning point. What happened wasn't a breakdown. It was a textbook correction inside a powerful uptrend. Specifically, the market was doing something it almost always does after a violent move higher. It went back to clean up unfinished business. Silver had surged from the low 70s into the 80s so quickly that it left behind a large imbalance in price structure, what technicians call a fair value gap. No real trading occurred there, no agreement on value, just air. Markets don't like air pockets. They're neat freaks that way. Think of it like skipping steps on a staircase. You might get away with it on the way up, but at some point, gravity insists you come back and touch the missing steps. That's exactly what silver did. The pullback into the London session wasn't weakness, it was gravity doing its job. The gap around $74 got filled almost to the dollar, and that alone should have told you something important. This market is being traded by professionals who understand structure, not tourists chasing candles. Here's where it gets interesting. After that gap was filled, silver didn't linger. There was no panic, no waterfall selling, no follow-through to the downside. Instead, the New York session closed comfortably higher, around 77. And by the morning of January 9th, price was already pushing back toward 80. That's not what a failed rally looks like. That's what strength looks like wearing a disguise. From a technical perspective, this was about as clean as it gets. The correction lined up perfectly with the 61.8 to 78.6 Fibonacci retracement of the entire move from roughly 70 to 83. These ratios aren't magic. They're not mysticism. They're a reflection of how human behavior clusters around proportion and risk. You see them in biology, physics, architecture, and yes, markets. When strong trends retrace into that zone and then reverse, it's one of the highest probability continuation signals we have. Silver tagged it, respected it, and bounced with authority. No drama, no hesitation. Just buyers stepping in exactly where they should. That's not coincidence, that's structure. Now, layer volume on top of that picture, and the story becomes even clearer. The selling during the pullback was relatively light, almost casual, but the buying on the rebound? Heavy, deliberate, purposeful. Volume expanded as price turned higher, which tells you everything you need to know about who was in control. Institutions weren't dumping positions into that dip. They were waiting for it. Liquidity was harvested, weak hands were shaken out, and supply was absorbed. This is how real bull markets behave. Corrections don't feel comfortable. They're designed to test conviction. They punish emotional traders and reward patient ones. And once that test is complete, price moves fast, often faster than anyone expects, because the fuel has already been loaded. Could silver still dip again? In theory, yes. Markets always have the capacity to surprise. A brief push toward 70 isn't impossible. But probability matters more than possibility, and right now, the probability favors continuation, not collapse, especially when you zoom out beyond the chart and look at what is happening on the fundamental side. This is where Asia enters the conversation, and it's a conversation most Western investors are still not having. While US traders are asleep and European desks are closing down for the day, Asian markets are doing the heavy lifting. For weeks now, the highest volume in silver hasn't been coming from New York or London. It's been coming from Tokyo, Shanghai, and Singapore, night after night. That's not an accident. It's a signal. China and Japan are not trading silver like a speculative asset. They're treating it like a strategic resource. And the numbers back this up. Based on recent delivery data from major Asian exchanges, over 150 million ounces of physical silver have been taken off the market in roughly the last month alone. Let that sink in for a second. That's close to 20% of global annual production absorbed in about 30 days. This isn't retail enthusiasm. This is state-level and institutional demand operating at scale. China, in particular, has changed its behavior dramatically. The tidal wave of liquidity created by its money supply expansion is no longer flowing into real estate or tech equities the way it used to. That chapter is closing. The capital is rotating into tangible assets, commodities, metals, materials you can't print. This isn't reactive, it's strategic. Convert paper into atoms before the paper loses credibility. That plan didn't start last month. It's been decades in the making. Japan is moving in lockstep. And if you want a glimpse into where the physical market really is, look at silver pricing in Tokyo. Physical silver there is trading at well over $100 an ounce, far above Western paper prices. That premium isn't theoretical. It's what buyers are actually paying to secure metal now, not promises later. When you see a 50% plus premium between physical and paper markets, the message is loud and clear. The paper price is lagging reality, and paper prices always play catch-up eventually. So when people ask whether silver can break $84 and head toward 100, the more relevant question is how long the paper market can pretend nothing has changed. Because under the surface, everything has. This isn't about fear, it's about alignment. Technical structure, volume behavior, and global capital flows are all pointing in the same direction. That doesn't happen often. And when it does, markets tend to move quickly and decisively. You don't need to panic. You don't need to chase. But you do need to be honest with yourself about where we are in the cycle. The easy prices are behind us. The decision window is narrowing, and silver, for better or worse, doesn't wait for consensus. Some people will get on this move calmly, deliberately, and with a plan. Others will watch it unfold, waiting for a pullback that never quite comes, telling themselves they'll buy when it settles down. And a few months from now, they'll be explaining, again, why they were right in theory but wrong in practice. Markets have a way of rewarding preparation and humbling confidence. Right now, silver is offering a very clear lesson. The question is whether you are repaying attention or just enjoying the show from the platform as the train disappears down the track. Let S zoom out for a second and ask the obvious question that everyone should be asking by now. Why are prices so wildly different depending on where you are in the world? Why is silver trading at one number on a Western screen and something completely different when you try to source the actual metal in Asia or the Middle East? The answer is simple, uncomfortable, and very difficult for the paper market to admit. There isn't enough physical silver to go around, and the shortage is no longer theoretical. It's real, it's visible, and it's forcing cracks into a system that relied for decades on the illusion of abundance. Demand for physical metal has become so aggressive that buyers are no longer price sensitive. They're availability sensitive. They're willing to pay enormous premiums just to secure supply. This is what economists refer to as regional pricing divergence, and it's something that almost never happens in a well-functioning global commodity market. For most of modern financial history, silver had one global price. You might pay $1 or $2 more in one region for logistics or taxes, but New York, London, Tokyo, Dubai, same metal, roughly the same price. That world is disappearing in real time. Right now, silver in Japan is trading north of $120 an ounce. In the UAE, you're seeing prices well above 110. In parts of China, physical is changing hands around 100. Meanwhile, the COMEX paper price is still sitting in the high 70s. That spread is enormous, and under normal circumstances, it would never survive. Arbitrage traders would immediately buy silver where it's cheap, sell it where it's expensive, pocket the difference, and force prices back into alignment. Except they can't do that anymore. As of January 1st, 2026, China implemented new export controls on physical silver. The metal cannot freely leave the country without government-approved licenses, and those licenses are only being granted to a relatively small group of exporters with close ties to the state. This isn't an official nationalization announcement with banners and press releases. It's something far more effective. By controlling who can export silver, China effectively controls how much silver reaches the global market. And when you control supply, you control price. This is economic strategy executed quietly, patiently, and with precision. No headlines, no drama, just policy. One of the sharpest minds in the commodity space, Lior Gantz from Wealth Research Group, summed it up perfectly in a recent interview. He said, "What we're witnessing is the end of the fake global silver price. Silver is being forced to rediscover its true value based on regional realities. And in regions where physical metal is actually needed for industrial use and where trust in paper promises is thin, that real price is 40 to 50% higher than what Western exchanges are advertising. That's not speculation, that's discovery." And this brings us to the decision point you're standing at right now. Because whether you realize it or not, you're already involved. You're either positioned for what comes next, or you were positioned to explain later why you didn't act when the evidence was right in front of you. There's no neutral stance in a market like this. At the moment, silver is trading in the high 70s, flirting with 80. The most important level on the chart is $84. That's the recent high. That's the level where the last rally paused. It's also the number every trader, fund manager, and algorithm on the planet is watching. And here is the part people consistently get wrong. What happens at 84 is indicating T gradual. When silver breaks above 84 with conviction, meaning volume, follow-through, and a daily close, the entire market dynamic changes instantly. Algorithms programmed to buy breakouts flip from neutral to aggressive buying. Hedge funds that have been waiting for confirmation rush in. Retail traders who panicked and sold at 74 scramble to re-enter. Industrial users who were hoping for cheaper prices panic buy to lock in supply before it disappears. All of that demand hits at the same time. And here's the problem. There is no supply waiting to meet it. The COMEX vaults are already under stress. China isn't exporting freely. Mines cannot ramp production overnight. You cannot just turn a dial and produce millions of extra ounces of silver. This creates a classic supply-demand mismatch right at a critical technical breakout level. When that happens in commodities, price doesn't climb politely, it jumps. We're not talking about silver inching higher by $1 a day. We're talking about overnight gaps, 84 to 92 before most people have finished their morning coffee, 92 to 100 in a matter of days. This is exactly how commodities behave in the early stages of supercycles, when technical structure and fundamental reality finally align. And if you want proof that something is seriously wrong with the existing system, look at recent COMEX delivery data. January is typically a quiet month. It's not supposed to see heavy delivery demand. Yet in just 72 hours, over 23 million ounces stood for delivery. That's not normal behavior. That's a bank run. Big players are no longer comfortable rolling contracts or settling in cash. They want metal. They want it in their possession. And they want it now. Even more telling is who's being forced to deliver. JP Morgan, the longtime custodian of COMEX silver, has historically been on the receiving end of deliveries. They accumulate, they store, they rarely hand metal over. Recently, they've been issuing delivery notices instead. That only happens when demand overwhelms supply. It's a clear signal that the vaults are under strain. Registered COMEX inventory, the silver actually available for delivery, is sitting around 120 million ounces. At the current rate of delivery requests, that inventory could be depleted within weeks, not months, weeks. So what happens if registered inventory hits zero? The exchange declares force majeure. Contracts are cash settled. Holders are told, politely, that there is no metal and they'll be compensated in dollars instead. And the moment that happens, the paper market loses all credibility. Physical silver is repriced overnight based on scarcity, not promises. Prices north of 150 would not be shocking in that scenario. They'd be logical. This is why it's increasingly unlikely that silver revisits the low 70s. The entities that truly understand these dynamics, China, Japan, Middle Eastern sovereign funds, large institutions, are not selling at 77 or 78. They're accumulating. Every dip is absorbed. The floor keeps rising. What used to be support at 50 is now ancient history. 70 has become the new structural floor. 80 is on the verge of flipping from resistance into support. This is how trends mature. Technically, the market is doing exactly what it should be doing right now. We're consolidating between roughly 76. At this stage, we are no longer talking about a normal pullback or a technical gap that might eventually get filled. What we're re-witnessing is what happens when paper pricing loses relevance and physical scarcity becomes the only thing that matters. Once silver clears the 150 level, we move into genuine price discovery. There's no overhead resistance there. No legacy sellers waiting to get their money back. Nobody loaded up on silver at 140 in recent history. Above that zone, the chart is clean. It's blue sky, and price is no longer guided by memory, only by urgency. At that point, the ceiling isn't defined by technicals anymore. It's defined by how desperate buyers become before mines can realistically increase production, which takes years, not quarters, or before industrial users attempt substitution, which for most applications is either impractical or outright impossible. That is why we're starting to hear numbers that sounded absurd not long ago. Some analysts are talking about $200 by mid-2026. Others see $300 by year-end. Andy Sheckman recently said he wouldn't quite be shocked by $400 or $500 silver if the monetary system truly fractures. Are those numbers aggressive? Absolutely. Are they impossible? Not at all. In a market where supply is capped and demand is functionally unlimited, price stops being a measure of value and becomes a measure of desperation. It's simply whatever the last buyer is willing to pay. Now let IS talk about the mental roadblock that S probably sitting quietly in the back of your mind. You're thinking, 77 feels expensive. I missed silver at 25. I missed it at 40. I should wait for a pullback. That line of thinking feels reasonable, but it's also how people miss life-changing moves. You're anchoring to where silver was, not where it's going. If silver is headed to 150 or 200 over the next 6 to 12 months, the difference between buying at 70 or 77 is meaningless. It's the same mistake people made arguing over whether to buy Bitcoin at 10,000 or 12,000 when the destination was 69,000. The entry price only matters if you don't understand the trajectory. And here, it's the harsh truth about waiting for pullbacks in this kind of market. They may not come. Or if they do, they'll be so fast and so violent that you won't be able to act. Look at what just happened. Silver dipped to 74 during the London session and was back near 77 by the New York close. That was a 3-hour window. Miss it, and it's gone. The market does not care if you were in a meeting, asleep, or waiting for confirmation. It doesn't owe you a comfortable entry. It only responds to supply and demand, and right now, that equation is brutally one-sided. So let me walk you through why prices in the low 70s are very likely behind us for good. First, China's export controls are not temporary. They're not a negotiating tactic. They're part of a long-term strategy to control strategic resources. Second, COMEX inventory is structurally depleted. Even if they manage to avoid an outright default in January or March, the direction is unmistakable. Metal is leaving the system faster than it's coming in. Third, industrial demand is accelerating, not slowing. Green energy, AI infrastructure, data centers, 5G expansion, military modernization, none of these trends are reversing, and all of them are silver intensive. Fourth, mine supply is flat to declining. It takes a decade or more to bring a new silver mine online. Even if prices spike to 150 tomorrow and spark investment interest, that metal won't hit the market until well into the next decade. Fifth, the dollar is in structural decline. 36 trillion in debt, multi-trillion-dollar deficits, and zero political appetite for restraint. And this isn't ideology, it's arithmetic. As fiat loses purchasing power, hard assets reprice higher. That's monetary physics. Sixth, the paper silver market itself is breaking. ETFs are facing redemption stress. Futures traders are demanding delivery instead of rolling contracts. The fractional reserve structure that allowed banks to sell 100 paper ounces for every ounce of real metal is unraveling. As that system collapses, price discovery shifts from promises to physical reality, and that reality is far more expensive than $70. Seventh, regional pricing divergence is accelerating. The gap between COMEX, Shanghai, and Tokyo isn't closing, it's widening. That tells you the market is fragmenting into local supply zones, and in zones where metal is scarce, price reflects scarcity regardless of what a Western screen says. Eighth, and this one matters more than most people realize, governments are waking up. The Pentagon-S multi-billion-dollar silver smelter project in Tennessee isn't IT happening because officials believe silver will remain cheap and plentiful. It's happening because they understand it won't. When governments start securing strategic materials, they don't do it at the top of a cycle. They do it because supply risk has become a national security issue. And once governments enter the bidding war, price only goes in one direction. So when I say we're probably not going back to the low 70s, I'm not being dramatic. I'm reading the evidence. And the evidence says the floor is rising faster than most people are prepared for. Yesterday's price may end up being the lowest price anyone ever sees again. That's how real bull markets behave. They don't offer comfort. They force decisions. Now, to be fair, let's address the counter-argument. Could silver still see one more sharp drop to 70? Yes, it's possible. Markets can always engineer one last shakeout. If there's a coordinated effort by bullion banks to trigger forced liquidations, we could see a sudden spike down. But understand what would happen next. Asia and institutional buyers would absorb that supply instantly. We're talking hours, not days. By the time most people try to act, price would already be back above where it started. That's where risk-reward becomes obvious. If you wait for 70 and it never comes, you miss a move to 150 or higher. If you buy at 77 and price briefly dips to 70, you're down about 9% temporarily before the trend resumes. Missing a potential 100% plus gain to avoid a single-digit drawdown is not rational. Every serious investor understands that math. This is not a day trade. This is positioning for a multi-year supercycle. Over that time frame, obsessing over the exact entry becomes irrelevant. What matters is exposure. So here's the practical approach. If you don't own silver, prioritize physical. Coins, bars, whatever you can reasonably source. Yes, premiums are elevated. Yes, delivery times are longer. None of that will matter in hindsight. When silver is trading north of 150,